Morning, everybody. It's Max Convexity. Kind of a windy day here in Austin. I'll keep the microphone close to me. I have a good one planned out for you guys today on this beautiful Saturday. It's called The White Paper Responsible for a $40 billion plus industry. How the covered call is changing the way we retire. All right. In the beginning, covered calls were for big money people only. That's how I got involved with them. I didn't have big money, but I had friends that did and family, and that's how I found out about them. But they were a secret of the rich and famous only. They were particularly useful for folks with concentrated positions in one stock. Jay Pestrichelli mentioned in his wealth management business, they have clients that come in with concentrated positions. Say somebody that's worked for Apple all their life. And, Apple's appreciated quite a bit in the past 20 years. And they have $20 million worth of Apple stock. They don't really want to sell it because their cost basis is so low. They come to people like Jay. Well, I used to do that kind of work also in the 90s when I was in wealth management. Like I say, and a lot's changed since then. So check anything I say with your own financial planner. This is just my my feelings on these matters. But the concentrated position, it's really helpful for those guys because they can generate income without generating the capital gain. Sometimes people that own stock in a public company can't sell also without having to generate a record and also maybe causing a panic. Or maybe they don't want to because, they believe in their company. Then, of course, for tax and estate planning, my dad did tax and estate planning his whole life. So I heard about him and discussed these kind of things a lot with him as well. So options haven't been around forever. Options themselves have been around. Option contracts between two people have been around forever, but they haven't been standardized until the 70s in the United States. The Chicago Board of Options Exchange, CBOE, I believe they were founded in 73. And it wasn't too long after that, in the late 70s, I started hearing about it. But when the standardized option came out, where options were fungible, call option one place was the same as a call option in another place. It wasn't like you had different arrangements with different banks, right? Like it was before. That when it's fungible, then it opens up a whole new industry, and it also opens up a whole new a bunch of opportunities as far as hedging it and everything goes. So the Chicago Board of Options Exchange released these buy right indices, and these are these theoretical indices that follow a portfolio that sells out of the money covered calls or sells puts or whatever. They have different ones. That came out in the mid 80s, or I'm sorry, in the early 80s, and that gave money managers something to benchmark against. So then I found this white paper, I don't know, 6 months ago when I first started getting back into covered calls through this YouTube channel. And I was I've heard all this stuff about how good covered calls were for years. And I knew there was tons of white papers out there. This is a good one right here. This is one of the best white papers. I didn't understand it when I discovered it 6 months ago, but this white paper, I believe, started the covered call business, essentially. The white paper came out in 2012, and really the covered call business here, covered call ETFs didn't really, in my opinion, start in earnest until 2013. There was a few out before that, but they were kind of oddballs. All right, so and when I say an oddball, there's one called PBP. It's Invesco. Invesco's a great company, and it's a buy right. I looked at the details just a second ago. It did not have a very good return, a long-term return. It's probably one of the things that gives or gave covered call strategies a bad name. Like I always mention, whenever I was being trained in my industry. They train you. They ingrain it in your head. Cover calls underperform. They could, and they do, and it's true. In money management, that's, you have to know that. You know, it's not like you've discovered a new source of money. They underperform in the long run. This, I think, maybe the reason people say that is because of funds like this. So PBP. I mean, that's not a very, that's a prime example of leaving money on the table. Not that this fund may not have worked in someone's portfolio, because once again, it's income instead of growth. But this is a more egregious example of leaving growth on the table. We all want income, but we don't want to sacrifice too much growth, right? Anyway, that's what this paper's about, and that's kind of what my channel's about. If you look here, I mean, this PBP, it paid $16 worth of dividends along the way. I mean, but that is over like 15-year period. But you can see, as far as capital appreciation, a lot was left on the table. So, but then in 2013, we had XYLD, QYLD, and Global X. And those were the first, what I would say, the good funds. So those funds are good. And a lot of people love those. And at the time, they were only show in town, you know, because you certainly didn't want PBP. I mean, you know, but Global X has, you know, had good performance. It was only show in town until, you know, for a few years, until the early 2020s, whenever JP Morgan came around, and now the business is blowing up. Global X, you know, it's a great family of funds. They you know, they have 45 billion under management, and they have some really inventive and original ETF strategies. I like it. I'm not disrespecting them at all. But lots of times their covered call fund is sometimes an example of leaving capital appreciation on the table, because they use the at the money strategy. So it seems like I pick on them a bunch, but I don't mean to. Now, JEP-I and JEP-Q, people probably think I'm being paid by them because I like them so much, and also Defiance. But I'm always calling JEP-I and JEP-Q kind of the gold standard, because they have, you know, low expense ratio, good returns, kind of a stingy dividend, but they have good capital appreciation. But all in all, it's great funds. Great funds, and it's hard to argue with 3.4 trillion under management. So let's look at this. Oh, and don't forget about this other thing. This white paper I'm getting ready to show you, and then I'll post a link to it, and you guys can look at it as well and tell me what you guys think. This white paper also started the hedged equity fund business, and I never talked about this on this channel. The other day, I did talk about a fund by a company called Innovative, and it was a fund that was that made it where you couldn't lose money, zero risk on the downside. It was a caller word, bought a put. In any event, that's a hedged equity strategy. You're selling calls to buy puts. I like to talk about income option trading, which is generally just selling calls. Once you use the money from the call to buy a put, it's a different kind of strategy. It's not that it doesn't have a place. To me, it's not as interesting to talk about. That's why I don't talk about it as much, but maybe I need to start talking about it more. I really like that fund I did the other day, TJUL. I mean, it's it's an interesting fund, and it's getting close to breaking the laws of risk and reward. Anyway, all right, guys, so let's look at this white paper, and let's see what we have. Let's see what I garnered from it, and then I'm going to post it, and then I want you guys to evaluate it. Let me know what you guys think. The last time I did this, I posted the white paper, and Tom, well, I always mention Tom, but one of my regular commenters, evaluated the white paper, then wrote me a little report and sent it back to me. His evaluation was more conservative than mine, but that happens sometimes. Tom and I are usually on the same page. He's just a little more conservative than I believe. All right, guys. So here's the top line thing is impressive. The total growth for, they have different indexes. Let's go to the indexes first. Okay. So they have the BXM. The BXM is just an at the money covered call monthly strategy. That right there is Global X. When you see BXM, just think Global X. Just think XYLD. The BXY, that's the 2% out of the money monthly covered call strategy. That's going to be JP Morgan. And a bunch of other ones. A lot of people use the out of the money covered call or some variation of that. They may use a 30 delta, but guess what? A 30 delta is generally 2% out of the money. And there's a benchmark that does 30 delta instead of 2% out of the money. But this study does the 2% out of the money, but they have similar results. Okay. Now the put right index, this is interesting. I don't know if you guys saw my video yesterday about there was a monthly put right fund. No one really watched that video. That's one of my worst videos I've done in a while. I mean, the thumbnail was ugly. I don't know. And it wasn't a very exciting video, but it was a First Trust fund against what was it? Put W? Yeah, PUTW. PUTW's Wisdom Tree, great fund. Nothing wrong with it. Anyway, that Wisdom Tree is based on this PUT right there. And there's other funds too. There's one called PUD that's semi kind of based on this. And there's other put right funds, but not a whole lot of them. Okay, here's the profit loss. Just to review, my regulars know this, but here's the profit loss diagram. Of course, the profit loss diagram of stock is just a straight, 45-degree angle, right? I mean, 1-to-1. You can make or you can lose. There's no variation like there is with options. With options, you can rearrange the risk and reward, and you can either cut off your downside, cut off your upside, do both, whatever. Okay, so the purple one is the covered call or the short put. A short put is the same. A short in the money put, which is usually how they do it, is the same thing as an out of the money covered call. So, or you could even say this: a short at the money put is the same thing as an at the money covered call synthetically. It's the profit loss graph is the same that puts you in the same economic position. So we know how those profit loss graphs look. They they come up and then they get flat at the top where the strike price is. Okay, well, the yellow one is a caller, and that's where you sell a call. So that gives you the flat on top. And then they have the flat on bottom too, where they buy a put. They can buy a put, and depending on where they put the put, that controls how much money they can lose on the caller strategy. Okay, well, anyway, here's the test that everyone's trying to recreate. I talk about this all the time. If a money manager, this would be like this is financial alchemy. If you could reproduce this test. These guys turn $1 into $12.53 from 1986 to like 2013. And just with the short put strategy. Okay. And the at the money cover call strategy, the Global X strategy did really well also. Now the out of the money index wasn't around yet, but those both beat the S&P. That's huge. And that's what bonds average. And down there, CLL, that's the caller. That index right there, sure, it underperformed. So, but that started a whole industry too. That's the hedged equity industry. That's their parent benchmark right there. So watch this. But when you include BXY, which is the 2% out of the money, and you start in 88 instead of 86, so you do take off the 87 crash when you do that. So that may be part of the reason, but you have 3 of these benchmarks outperforming the S&P, the Russell, or bonds. And then down here's the caller. Caller makes 6.1%. Yeah, and you're underperforming, but you don't have a whole lot of risk, right? Because they're buying puts the whole time. You don't have a black swan risk. A caller strategy is not going to be down 20%. Or it's not designed to be. They usually put the put. We'll talk about that in a second. They usually put the put 5% down on the caller benchmark. So it shouldn't be able to lose a whole lot more than that. With caveats though, but in any event, the short put strategy worked great. I don't know why there's not more funds. I can't really think of a fund other than that Wisdom Tree one I showed you, Put W, that's just trying to do this one. And really Wisdom Tree is doing it because Wisdom Tree does at the money put. So Wisdom Tree has had pretty good results, but so anyway, Wisdom Tree's doing that. But the JP Morgan one, I like this one better because the 2% out of the money, and we talk about that all the time on the channel, it leaves upside. So you get a little bit less premium, but you get more upside capture. So in any event, so there's Global X down there, there's S&P. Okay, so this is interesting too to look at. All right. So this is a scatter chart of return, but also risk, and they measure risk by standard deviation. So the further to the right on this chart that it is, that means the riskier it is. Here's Goldman Sachs Commodity Index. And also then it says high on the chart. The height on the chart is the return. So here you go. You can go over all the way over here to as risky as you can get, and it's commodities, and you can make 6%. Okay. Or you can come back over here and make 6% on a collar, CLL, which is the selling the call to buy the put, a collar strategy, collar benchmark. You know, you'll underperform the market, but look, you do it with you make 6%, but you make 6% with half the risk of commodities. So half the ups and downs. So half the margin calls, half the stop loss runs, half the bad stuff. Volatility is bad when you're a buy and hold it. Volatility kills buy and hold because that's what causes fake outs. It causes all the stuff that's bad. That's why these benchmark strategies and these strategies in general are so important to money managers and to retirees, because things like the collar strategy or the short put or the out of the money call or whatever can make you the same income as buy and hold, the same appreciation, but with less risk. So less margin calls, less bad stuff happen, less headaches, less thinking, man, should I sell this? Anyway. All right. So I like this stat a lot too. Okay. So these are the years and these are the returns for the year. So I just think it's important to note 2001, these strategies that are supposed to buffer so much. I'm always talking about the buffer report. Didn't really offer that much buffer that year. Market was down 12%. The at the money call strategy was down 11. The out of the money call strategy was down 11.4, just basically the same as the market. The short put strategy was down 10.6, caught about 90% of the, downside. Okay. Well, then the next year happened. The market was down another 22%. So that's like 33, 34. If you add those up, that's 34% over 2 years. Well, you look at the over 2 year performance, BXM was down 7 or 17 over 2 years compared to the market down 34. Well, that's pretty darn good. BXY was down, what is that, 23, 24, something like that, where the market was down 34, so in any event, the buffer started to kick in. But then here's the really impressive thing, especially with the out of the money covered call strategy, the BXY, the one that I like so much and we all like because it has the most juice on the upside. And it's the one JP Morgan likes. So look, then in 2003, when the market started going up, market went up 28%. The out of the money covered call strategy caught 25% of that. That's massive. The next year, the market was up 11. Out of the money strategy was up 9. 9.7. So but then watch this. In 2006, the market was up 15, and then this strategy starts outperforming. 2007, it also outperformed the market. 2008, the market was down 37%. That's one of the worst markets in my lifetime, or it is the worst extended market in my lifetime. I don't know. 2001, 2002 was pretty bad too, but I'd say 2008 was the worst extended market in my lifetime. And this is just over a course, it's down 37%. It was down 50% from high to low, or 60% from high to low, or something, highest point to lowest point. In any event, look how well these did. The out of the money covered call, 31%. It caught about 80%. That's about a 20% buffer. Now, I'm always ragging on the Global X ones. The thing about selling at the money is you have more buffer, so you do better in a down market. And so we would expect them to do better in the down market, and they did. And then look at this. Then the caller, we would expect them to do the best in the down market because they're selling calls and buying puts. So they caught about, a little more than half the downside. That to me is kind of the disappointing performance. I would expect my caller fund not to be down that much, but they must have had some tracking error or something. I don't know. Anyway, but still, in any event, that could save you from a margin call. 23 to 37 is a big difference. I mean, it's almost, it's a big difference. Okay. But then the important thing is 2009, when the market turns around, look at this. The out of the money covered call fund beats the market on the turnaround because it's selling out of the money. That's whereas the more conservative Global X strategy doesn't, and the collar strategy certainly does. So then the next year, is more typical. All the funds underperform, or it's more typical to how the fund years have been lately. Then in 2011, we have a sideways year. I'm always talking about sideways years are, that all of these funds better outperform in the sideways year for darn sure, except the collar fund. A sideways year is actually the worst outcome for a collar fund, because they want either a big down year or a big up year, I think. But a sideways year, they aren't making any money off the call because they're buying it on puts, but it's the market's not going down enough to make their puts, so they're just losing on both ends. And sure enough, that's what happened. So none of these are perfect solutions, but they're all solutions for different people depending on different circumstances. But I really like that. Okay, so right here, this just shows you the green is the returns of BXN, which is the at the money covered call strategy. So it's important to see the blue is just the returns of the market as a whole. So what having a covered call strategy does is give you more returns in the middle. Because you had 67 months of 0 to 2% up with just owning the market. Well, if you do the covered call, you have 118. That's what I'm saying. These strategies do great in sideways markets, right? You can see they take occurrences from the tails and they move them to the middle. So they're just messing with the statistics, which is what I like. This is using math to beat the market. Math is your edge when you're selling covered calls, and you can see it right here in the distribution of outcomes. This is, and sure enough, just like we would expect, you would expect, like when the market goes up a bunch, covered calls underperform. And sure enough, in big up months when the market's up between 6 and 8%, the covered call strategy only had 5 months like that, whereas the market as a whole had 18 months like that. So, don't do as well there, but we move a lot of those occurrences into this area. The thing is, on the downside, we don't have as bad of as we get a really bad down month, down 2% to down 4%, regular fund, or the SPY, say 26 times in this period, 26, whatever this is, months. Yeah. Covered call strategy, only 12 months. That's a gigantic difference. It's moving those occurrences up here, and that's because it's collecting that extrinsic premium, and you know how that works. All right, so the short put strategies, it's the same thing as the net the money covered call, but the put works a little better on these long-term statistics because puts are more expensive, because puts on indexes. That's one of the secrets to life, is you want to sell puts on indexes. Puts on indexes run more expensive. It's not a secret to life, but it's a secret that a lot of traders know. They try to always short index puts. Index vols are jacked traditionally. That's the way it works. The theory on it is because institutions use things like the SPY and the SPX and the triple Qs and the NDX to hedge their gigantic billion-dollar portfolios. They'll buy puts and put spreads. They'll sell calls. They'll buy callers, but because of that, it causes pressure on puts. Prices of puts are elevated. So as a small trader, what I want to do is I want to sell puts whenever it's practical. Okay, so now here's the out of the money strategy, the BXY. I think it's a better strategy, but when you look at the occurrences, it doesn't have as dramatic of an effect as the at the money strategy. But it does put more of it does do better on the upside though. But that's, it moves the occurrences to the upside, but to me, it doesn't have as dramatic of a difference. And here's the collar strategy. So the collar strategy just pretty much eliminates bad move, and it should. You have no months that are 8% and below, and you shouldn't, because you're buying a put 5% under the market. Generally, the collar The way they do the benchmark is you're selling a call 10% above the market on a monthly basis and using that money to finance buying a put 5% below the market on a monthly basis. So they take occurrences out of those bad, they change the distribution from there and move it back towards the middle. Okay. So here's the positive and negative returns on the month. This is kind of just a different way of looking at the same statistic. The market in general, 63% positive, 37% negative. Okay. The at the money covered call strategy, 71% positive, 29% negative, right? So it's better because it's moving occurrences from negative to positive. Same thing here. The short put strategy even does better, even though mathematically it should be the same. It does better because of the higher volatilities. So 76%. Now the BXY, because this is the more high power version because it sells out of the money, so it gets more upside, but because it's more efficient at capturing upside, it's going to be less efficient at gathering income. And the income is what causes the buffer. So sure enough, it's still better than the S&P 500, 67% positive occurrences, but it's not quite as good as the more buffered versions that do the at the money. See, this study shows you that at the money isn't bad necessarily. It's just, it depends on the use case. The reason right now we're also focused on out of the money is because the market's in a freaking face ripper and has been since October of this year. Just blowing up, well, until 3 weeks ago. And so that's why everyone wants, so a lot of that is recency bias, for sure. But the other thing you could do, if you're one of these guys that likes to switch and likes to reallocate and stuff, if you're in a bull market, allocate to the ones like JP Morgan and the ones that have more upside. And then as the market conditions change, maybe allocate into a Global X or the Defiance, the ones that have more buffer. You can kind of control that yourself once you understand how they work. That's why I started my channel. I just thought it was unfortunate when people didn't understand how they worked and they thought these were Ponzi schemes and going to zero in a hurry and everything. And they didn't understand that the selling of the option was actually reversing the process. And people that buy options, that's going to happen to them. But this is attempting to do the reverse in any event. So that's why I started the channel. But now that I've been going for a while or whatever, there's so many choices out there. So we can just drill down and you can choose exactly the risk you want. Look at this. This also cuts the highs and lows. Unfortunately, well, you want it to cut the lows. But anyway, well, we won't look at that. We looked enough. So these over-under charts are interesting too. I'm going to post the link and let you look at these scatter charts yourself. But you can go down the rabbit hole on these and you can really see the distribution of outcomes and how the strategies, and you can see the math at work here. Like on this caller strategies, the distribution of outcome, because it cuts off any bad occurrence, and pretty much it cuts off a lot of the occurrences that are low compared to this one. See, here's the JP Morgan strategy, the JP Morgan 2% out of the money cover call strategy. So what do we know about that? Not much buffer, right? So market goes down. I think the line represents the market. As the market goes down, so does this fund. It may do a little better. Being on top of the line indicates a little better, but it still has a lot of occurrences down here. Well, not so much on the caller fund. It cuts those occurrences off and moves them up. And it's because of the shape of the profit loss graph. Like I say, I'll be interested to hear what you guys think about this. Then it gets down here into Sharpe ratios and stuff. And once you put a Sorrentino ratio on it, or Sharpe ratio, or standard deviation, there's any number of ways to measure volatility and risk and reward. And just about in all cases, these do better than buy and hold when you start using risk metrics. This just kind of shows you more how it works. This talks about the favorable treatment, that the index options, all these benchmarks are done with the 60-40 favorable treatment index options that we all love so much. And that, and that's the reason. It's because of these rules. And they talk about it here. And heck, they even give you a link. So like I said, I know a lot of my people are smart people that are going to do their own research. So I'll post a link to this, and I'll be anxious to hear what pieces of information you guys are able to glean from this. I've told you pretty much everything I noticed. I hope this helped you. You know, I'm going to get back to work here. I got another video planned I'm going to shoot later in the day, and maybe I'll take Jackson to the park later. I don't know. Let me know in the comments what you guys are going to do with your Saturday. All right, guys, I really appreciate you guys watching. I know this one's a little in the weeds. The next one will be less in the weeds. How about that? All right. Have a good one.